Good afternoon, everyone from the UK. I think we'll get going on the webinar now. It's really great to see so many on the webinar here today. I do hope you're all keeping well. We've got lots of people on the webinar from Hong Kong, Singapore, here in the UK and Europe. Today's webinar will be about specifically some key areas where we see opportunity to invest. And I'm going to spend some time just sort of reflecting as well on, why should you invest in property at this time? We see lots of economic challenges, but I'm going to try to get into the fundamental reasons as to why property is a very strong long-term asset class. So before I do that, let's get into the presentation, and I'll just share a little bit of background to IP Global and also myself. So for those who don't know me, I've been with IP Global since 2006, 17 years now. I started in Hong Kong. I moved to Singapore, set up our Singapore office in 2009, and recently relocated to the UK. So based out of the UK now, and then I trip out to Hong Kong and Singapore to have client meetings and undertake presentations. So here's a bit of background on the business. We are a very experienced property investment company. We've transacted over $3 billion of property, not far short of 6,000 properties sold, and that's across 18 countries. And we've got around about 60 people in the business across Hong Kong, UK, the Middle East, South Africa, and here in the UK we have a big presence for IP Global. So in terms of the next slide, if we move on to the next slide, please, Bella, thank you. So we've invested in many markets. We are not just a company that focuses on one particular market. We have tremendous experience across such markets as the US and Australia. And our key markets now, which are Portugal, Germany, and UK, which I'm going to touch on today. 2 of the 3, we've done over 150 million euros of investment in Germany. And in the UK, we've done 115 projects in the UK since 2009. Now, these are 2 markets that we understand very, very well in UK and Germany. And I'm going to spend a bit of time talking specifically about those markets. And then I'm going to finish off with Portugal, talking about the golden visa, which will be coming to an end quite soon. Okay, so let's talk about the business model. So the business model is very, very unique. We are not a property marketing company, for want of better words. We don't just market property on behalf of a developer without taking financial risk. We actually take financial risk. We actually invest our own money in projects to negotiate better deals for our investors. And in effect, whatever we do not sell by the time a project is built, we have to buy any of the unsold units. So in simple terms, we have a project, for example, in Manchester at the moment, a superb opportunity, which I'll touch on today, called The Bailey, 104 units. We've negotiated to take the whole project. We put capital down on the whole project. We've signed a legal agreement with the developer that by the time of completion next year, whatever we haven't sold, we buy. So if we've got 5 units left at £250,000 each left, that is basically a check for £1.25 million we need to write to the developer, and then we hold those units. So you can see from that we have skin in the game. Clients like the fact that we are aligned with their interests, and we also do not get our capital out until the project completes. And this is a very important point, because what that means in effect is if there are challenges along the way with a project, and we all know that there can be challenges in property, what that means is we are there aligned with the clients to help them all the way through the process to complete on their transaction. Now, a lot of property companies, they get paid on exchange. So if there's a problem after exchange of contracts, you are really at their behest as to how client friendly, customer conscious they are in terms of helping the client all the way through to a project completing. We are absolutely 100% aligned with our investors through thick and thin, and that's an important point. Because we invest our own money, we don't do many projects. We have to do a tremendous amount of research and due diligence. How well capitalized our developers? Do they complete on time? A lot of research before we are confident to go forward on a project. So that's one half of the model, lots of research, due diligence, our own money invested. On the other side, when we do go forward, we have the lawyers available for the client. The lawyers will guide the client all the way through the buying process for the contract. When a client needs the mortgage, we have our team at Liquid Expat who will assist the client without having them go bank to bank. And the lettings and management service. So this is our own business, Complete Limited. When I put on the first slide, 5,700 properties they manage. We effectively do everything from finding tenants, drawing up the agreements, putting the rent in the account, right the way through to resales if they wish to sell the property one day. And then during the journey, we actually will provide periodic updates. Before completion, I talk to all my investors to update them on their investments. And then post-completion, we can get valuations, etc. So it's very much about building a long-term partnership. Next slide, please, Bella. Okay, so that's IP Global. We also have IP Investment Management. So this is a commercial real estate business that effectively develops commercial assets from ground upwards. So in effect, the difference between IP Global and IP Investment Management is with IP Global, you own an individual property. With IP Investment Management, you are investing in a property, commercial asset, or a series of commercial assets, typically from ground upwards, where there is tax structuring done, where you own a share of that investment. And IP Investment Management do the whole works from ground upwards development to getting planning permission, financing, leasing, holding assets, and exiting to institutional investors, pension funds, family offices, typically after a 5-year period. These are regulated under the SFC and MAS. So it is not information, given that you need to be typically a professional investor, that we share on our website. We share specific project details, and therefore it's something that if you are interested to learn more, please do drop me a line. We've put some stats on there. They have very good experience of investing over 600 million USD worth of assets. Core sectors, UK student accommodation, build to rent, multifamily. So if you are interested to learn more, do drop me a line and I can put you in touch with the relevant individuals there to help you. Next slide, please, Bella. Okay, so this is an important slide. I think, in the economic environment we live in, I think it's very important to understand and sort of look at why invest in property? Why invest in property right now? Well, there's a lot of uncertainty out there. And I think bricks and mortar give people confidence and give people certainty and assurance and confidence. So let me just go through some thoughts here. So first one, less risk due to illiquidity, resulting in fewer market fluctuations in general. Okay, so what I'm saying here is, if you think about when you invest in stocks and shares, we can all look at the portfolios day in, day out. You can get out very quickly. Property, actually, you don't have that worry. You can't sell a property in a day. The illiquidity, the fact that it takes time to sell, the fact that consequently you do not get that volatility, those huge day-to-day fluctuations that perhaps you can get with a share asset class. Basically mean that it is a strong and stable asset class. Yes, valuations will move, but of course, it's always a 5 to 10 year investment hold. So we know that during that time, there will be cycles, there will be ups and downs, but you are not investing for 3, 6, 9, 12 months. And we know that if we go back 5 years, 10 years, 15 years, we know that property will have been cheaper then than it is now. So it's very good that it has that illiquidity. Of course, you need to have accessible savings, etc., as part of good financial planning. But property sits very well as a illiquid asset. Generally passive income. So if you look at the markets we invest in, we look at city centre locations. We look at areas where people need to live and work 365 days of the year. So these are properties where you know that you will be able to get a tenant, and we can back that up. You know, we have vacancy rates of typically less than 1% across our markets. So we know that you can be very, very confident that you will get a tenant in your property. A mortgage allows for leveraging of unowned capital. So what do I mean by that? So let's say, for example, you buy a property for £100,000. You put down your 30%, which is typical, and then basically the bank lends you 70%. They lend you £70,000. Why does the bank do that? Well, because they have faith in the asset class. Of course, the bank will do surveys, etc., to confirm that it is an asset worth lending on. But typically, banks lend on property. They lend on property in markets with good legal structure, such as Germany, such as the UK, etc. And the fact is, if the bank's going to lend their own money, then you can be sure that it's a good place to invest your own money. Tax benefits. So tax benefits. So we hear a lot about, is it still worth investing in the UK because of changes to the rules and regulations around buy-to-let and other markets? Well, again, if I focus on the two main markets I'm talking about today, UK and Germany, in the UK, most people invest in a company structure these days. By paying corporation tax, it's actually lower than income tax. By investing in a company structure, you can plan very well to assist with inheritance tax planning. And also by investing in company structure, you can actually downsize some tax on sale, meaning that the new buyer's stamp duty will be reduced. So there are some actual good tax benefits through doing a company structure in the UK, which I can share more on a one-to-one. But for Germany, again, as a standout market, with Germany, you hold property for 10 years, there's no capital gains tax at all, nothing. And for income tax, you can offset your mortgage interest to your rent. So it's very, very tax efficient from that perspective. And then finally, interest rates and housing supply and demand. So interest rates, we all know interest rates have been going up. My personal feeling is there's going to be 1 or 2 more rate rises. I think we've seen with inflation in the UK today, inflation numbers will get a rise tomorrow. We might get one next month. But I think if you look at the last 18 months or so, I think we're coming to the end of the cycle. But the point here is, with interest rates going up, less people have been buying. And what that means is more people are renting in an already undersupplied market, and rents have been going up. So by virtue of interest rates going up, rents have gone up, because you have to do 1 or 2 things. You either buy or you rent. You don't have a third choice. And that kind of leads me nicely into housing supply and demand. You know, one of the key things we look at is what is supply like in these markets. Housing supply and demand in the UK, in Germany, is incredibly undersupplied. Why is that? Property regulation, Building regulations mean that energy efficiency is even more important than ever. It takes much longer, therefore, to get planning permission. Planning rules have always been slow in Germany and the UK. And the fact is, since COVID, different things are going on in the market. Less people want to share. They want perhaps some office space to work from home. So there's been a huge impact of more and more people looking to get into the rental market, get access to property. And obviously, with interest rates going up, there's less property being built because it costs developers even more. So undersupply is going to be here for a long time. And you're going to find that's a common theme in this presentation, which really underpins the value of investing in property. Next slide, please, Bella. Okay, so I'm going to talk about a couple of key markets briefly. I'm going to talk about Berlin. I'm going to talk about Edinburgh. I'm going to talk about a new Oxford project, share thoughts on Manchester and Sheffield, and finish up with Portugal, and then we'll go into questions. So Berlin, I was there a week and a half ago. Magnificent city. The more I go back, the more I buy into it. Very, very interesting location. In simple terms, it's a tier 1 city with tier 2 pricing. Why is that? Well, it's because of the unification challenges that took over 30 years to overcome. When East Germany and West Germany was united in 1989 at the fall of the Berlin Wall, it took many, many years for Berlin to really evolve itself from an incredibly poor city to one that is now sort of cutting edge technology and incredible infrastructure with a new airport, Europa City, so much investment going in. So that is a great picture of Berlin, just showing it. But taking a step back for 1 second, so Berlin, world-class market, and I'll touch on the project there as we go through. But why invest in Germany? So these are the reasons. Tax side, it really stacks up. No tax on your profits after 10 years. You get pre-approval for mortgage, so you don't have the worry, such as you do in other markets, where you have to wait until just before completion to get your mortgage agreed. Fixed term interest rates, I think this is really important. You can actually get a 10-year fixed rate mortgage for 3.91%. Now, think about certain markets where you can pay 6% for a 2-year fixed rate. So you can get some incredible mortgage deals in Germany. Stage payments. So as the building goes up, you use your mortgage account to fund the development. But the legal structure is so good in Germany that the lawyer will undertake to check every single payment, that basically all is in order as the building is developed. Compensation for delayed construction. So this is a really reassuring point for the investor. If there are delays on build, there is compensation paid. Now, we've had a number of very successful projects, but we've also had 1 or 2 that have been delayed, and the penalties are paid out without quibble immediately. That's why typically projects run on time in Germany. And underneath all of that, it's the 4th largest economy in the world. So it really is the powerhouse of Europe. Next slide, please, Bella. So I mentioned about supply v demand is going to come up through this presentation. So I'm not going to go verbatim through every single figure as they're on the screen there. But the point is, again, Germany, like the UK, is a very undersupplied market. It's got a growing population. Since the Ukraine war, more and more people are going to Germany from Eastern Europe. They are heading to the capital, Berlin. And as the lettings manager we have in Berlin said, there are jobs here. There are lots of jobs here, but what there isn't is accommodation. That's the challenge. And that is why you see upward pressure on rents, because of the fact of the undersupply, fact that the population is growing. And we've had our Berlin office for quite some time now, and it is incredibly low vacancy rates there. which is very, very reassuring to investors, particularly those investors who are thinking, well, I like the German story, I've heard about it, but what about the rental side? If I've got a mortgage, will I be able to cover the mortgage? And there is no question about that. Next slide, please, Bella. So here's just some stats on the market. If you look at Berlin, very consistent growth, both capital appreciation and rental growth. So the point we would make is if you look at other tier 1 cities in Europe, Paris and London, it is a tier 1 city, but it's tier 2 pricing. That's really the opportunity. And just on the end there, the vacancy rates are less than 1% of properties are vacant. Incredibly strong rental market. Okay, next slide, please, Bella. So we take a breath and we'll look at Edinburgh. So I was in Berlin the other week. I've been fortunate enough to go to Edinburgh twice. So Edinburgh is the capital of Scotland, as it says there, it's a powerhouse of Scotland. If we get into the next slide, effectively what we see, go to that one, is a city that's very similar to London. So you see the buildings there, these old historic buildings, lovely greens, you have the castle in the centre of the city. So why invest in Edinburgh? It is the top, some of the top universities in the UK, aside from Oxford, Cambridge and London. There was a huge talent pool there. Students stay in the city when they graduate because it's an attractive city. And therefore, there's a lot of big corporates there looking to attract that top talent. And there's a lot of new industry in tech, and renewable energy means a lot of wealth creation going on. So Edinburgh is the UK's leading technology ecosystem outside of London, home to 75% UK's potential renewable energy industry, and a very, very competitive marketplace. So these are some of the reasons we like Edinburgh. And if we go into the next slide, we're just going to share some sort of more information here. So look, that shows you some of the beauty of Edinburgh. Beautiful surroundings. You have the castle in the centre of the city. So what we see is the second most populous city in Scotland, but effectively the most prosperous city with one of the strongest economies of any city in the UK outside of London. It's expected to see the highest house price growth of all major UK cities. Now, some of the reasons for that is if you have a look at that picture, it's very difficult to build in Edinburgh. The geographical makeup, geological makeup makes it extremely challenging to build. And then coupled with the traditional slow planning rules and regulations means that you do not get much build come onto the market. We've only been able to do one project since 2010, but we're delighted that we have another project there now, which I'll share more on as we go through. So we'll go into a bit more of the detail on the numbers. So let's have a look here. So above average growth, we've seen above average growth since 2010. We are seeing a good positive trajectory going forward over the next 4 to 5 years in terms of rents and capital appreciation. Indeed, I was just reading a report yesterday, a Zoopla report, which basically had Edinburgh as the top market for rental inflation, 14.9% actually. It tops the country. Now, we're talking about rental inflation coming off slightly, but actually it's still going to be way into double digits. So it's very strong on the rental side. You're talking about probably one of the only cities I know where you're talking about a 5% yield. And that is quite incredible. So a very, very strong market for rental and capital appreciation. Next slide, please, Bella. So just going to the south of the United Kingdom now. So moving to Oxford, in many respects, a similar city to Edinburgh, a global hub of education and science, the top university in the world is in Oxford. And also we have Oxford Brookes University. So an incredible amount of educational talent in a very attractive area to live. So if we just go into some of the detail here, onto the next slide, please, Bella. Why invest in Oxford? Well, first of all, it's a very attractive place to live. It's got a really nice town centre, beautiful countryside. It's effectively a London market. I live in Cambridge, which is like a London market. Oxford is like a London market. It's basically, obviously, extremely well known for education, but it's as a result of all that academia that feeds off of that, it's the third largest digital cluster in the UK. Consequently, unemployment is lower than the national average, 3.3 versus 4.4, and it's got a huge and growing economy. So these are some of the reasons we like Oxford. And if we go into the next opportunity slide. So there's the university scene, Oxford University. It's home to world-class universities, and it has an incredibly rich history, and the heritage brings people into Oxford. Immense pressure on the city's housing stock. I can't emphasize enough how undersupplied it is. If you were to Google property in Oxford, new builds, you would struggle to find anything. It is incredibly undersupplied. And the industries are obviously based around education, which is always strong and stable, particularly in major cities such as Oxford with top universities. Human health and social work, information and communication. Obviously, huge digital cluster hub for the UK. So lots of industry, lots of people earning lots of money, very undersupplied market, everything we want to see in a property market. Next slide, please, Bella. And then again, there's some stats. If you look at going forward, it's very, very positive in terms of capital appreciation and rental yield. Again, the undersupply stats are very, very strong. It's a very compelling story when you look at the lack of build coming onto the market. And as I say, I urge you to have a look around Oxford, have a look at the rental market and just see how much property is coming onto the market. And you will see why, as a result, we are investing in this area. We have managed to secure a project in Oxford, which is very, very sort of sought after. Okay, next slide, please, Bella. So on the UK side, before I sort of just flick over to Portugal, I'm just going to talk briefly about Manchester and Sheffield. Two cities, again, now that I'm permanently back in the UK, I've been able to visit. Two cities where there's a tremendous amount of regeneration going on, dating all the way back to when the government started investing in the north of England, effectively trying to de-risk London. So again, there's a whole plethora of stats on the screen there. You know, Manchester has the high-speed rail link going into it from London. The airport is being redeveloped. You have Media City, which is like the equivalent of Canary Wharf in London for financial services. Media City to Media, Radio 5, all the BBC radio stations, Google, ITV, Salford University, the list goes on and on. And the footprint of Media City is doubling over the next 20 years. So lots and lots going on in Manchester. We've been investing there for quite some time because we see it as a long, stable market. We have our own lettings and management office there. We have a number of projects we run. And again, when you look at the data, when you have a look at all the stats, and it's a common theme of why we invest in certain areas, you know, population growth, GDP, undersupply, you know, these are the things as investors you need to look out for when you are looking to make investment decisions. Next slide, please, Bella. And then Sheffield. Sheffield, again, wonderful city. Again, referring to my Zoopla report that I was reading yesterday, it has some of the most affordable rents of any top 10 city in the UK. So Sheffield is the 5th largest city in the UK, and a very, very attractive city. So within the city, you've got a big transformation since the old steel industry days, Tata Motors, Boeing, McLaren, HSBC, making it a real sort of global city. And then on the outskirts, wonderful countryside. So a very livable place. And it's kind of late to the regeneration side. So rents are still very, very affordable. In London, you'll spend 40% of your income on rents. In Sheffield, you'll spend 20%. So that affordability is going to drive rents, it's going to drive pricing. And that's why we've invested there. Next slide, please, Bella. So leaving UK and Germany for one sec, and then I'm going to come back to a roundup of all our projects in a moment. Let's talk about the Golden Visa. So first of all, what is Golden Visa? Some of you may or may not know. It's an opportunity to get an EU passport through investing in Portugal in one of a number of different ways. We focus on the property elements. We have a fund as well you can invest in to get the EU passport. But in effect, the scheme is a great opportunity to invest in a country where there are some really excellent opportunities to invest in property, to get an EU passport, not only for yourself, but for your family, your wife, your children, your elders, to travel visa-free throughout the Schengen region. And effectively, as I always say to people, it's an investment first and passport second. But the scheme is coming to an end. It's coming to an end over the next couple of months. So there is very much a last chance opportunity to get an EU passport. So Bella, if we can just go into the next slide. So earlier this year, it was announced the scheme was coming to an end. So where we are in the process now is that is being debated through Parliament. Now, the earliest this could come to an end is in the end of July. So we are seeing a tremendous amount of interest in applications coming in at the moment to secure the EU passport. Lots of people from the UK, from Asia, from the US are very keen to get access to an EU passport, but it is coming to an end soon. If we can just flick onto the next slide, Bella. So in effect, there was an announcement in February. It wasn't the best communication, to be honest. It led to some confusion. It actually paused applications at that side. But then once we got into March, April, there was more clarity that, look, it's going to end, but there will be time to get your application in. So in recent weeks, we've seen a lot of people going forward with the application. So if we just move on to the next slide, Bella. So basically, all applications need to be coming into force. I don't want to get too much into technicalities here, but in effect, once you make your investment, the lawyer works on your application. I work with an excellent lawyer. So if anyone is keen to have a conversation with the lawyer, I can connect. He'll do a free Zoom consultation or meeting to help and tell you what documents you need, etc. Once your investment is made, your application is filed, within 9 months, you will get access to what we call the Golden Visa, which will allow you to live and work in Portugal. And then you need to do 7 days a year in Portugal for 5 years. And then you can apply for your passport for you and your family and elders at the end of that 5-year period. But it's coming to an end. So in terms of just moving on to the final slides there, Bella, for Portugal. So we are talking about the fact that it's due to end in July. However, it then needs the presidential consent. It may well be there's a transition period. So the point I would make is this. If you are keen to discuss this, do not hesitate, drop me a line, and obviously I will be able to discuss this and help you in terms of the options available, and also connect you with the lawyer who can assist for the Golden Visa. Next slide, please, Bella. Okay, so now we've just come to the end of the presentation. And what I'm going to do is I'm going to talk you through what we're up to specifically project-wise, and then we'll go to questions. So we're planning to launch in York, wonderful city, 2 Russell Group universities. Again, I've been fortunate enough to go to York. It's got a racecourse nearby, but it's all about the economics. Major corporates there, Aviva, Nestle, lots of startup businesses, very much an undervalued market compared to the likes of Leeds, for example, nearby. But a beautiful city, similar to Edinburgh. If you look at that, it's got the old Roman walls, etc. Very tough to build. Attractive city. You're buying a 1-bedroom unit from sort of £195,000 again with a super yield of 5%. So I'd definitely look out for that one. And then if we just go through to the next slide, Bella. So these are live projects. So just a quick 2 minutes on these. This is the Oxford project, the Stormont. We only launched that literally 10 days ago. A nice building of 8 units. We've already sold 4 of them. And it's all about the fact that this is a London market, a growing market with an incredible economy outside of London, linked to the long-term fundamentals of the excellent Oxford University as University 1 in the world, and all of the support network of industries linked in with education, where there is way above average earnings and lower than national average unemployment. The Carrick, I talked to you about the low supply levels in Edinburgh. Why did we get this project? It's a developer we've worked with 7 times before, Mandel Group, super developer. So difficult to get stock here, but yet we have 1-bedders from £250,000 with a 5% yield, only 8 minutes away from the city centre. A really good opportunity. Langford Tower, this is quite unusual. It's a refurbishment we're doing in the city centre. Again, as I shared with you, affordability-wise, Sheffield is one of the most affordable cities in the UK because it's very much up and coming in terms of its regeneration. So that affordability will basically mean that you're buying into a market where there's a lot of potential for growth. As I mentioned, rents are half of what they are in London, but there's a lot of above average salaries because of all the new corporates moving into Sheffield because of the infrastructure changes. And then finally, the Bailey in Birmingham, Silversmiths. So Silversmiths in Birmingham, super project, second project with MVMM in Birmingham. I had 5 investors in the first project with this developer. This is incredible location. It's the jewellery quarter, where they still have 40% of the UK jewellery industry. Is literally a short walk into Birmingham city centre, which is being transformed beyond belief. So you have like a village feel, and then you walk into a cutting edge city with HS2, lots of big corporates moving out of London, and a city where with HS2 you'll be connected within 45 minutes by the time HS2 opens. And one of my favourites as well, the Bailey. Again, it's with the Mandel Group that we've worked with 7 times before. You know, we're talking about a project here, an average price of £380 per square foot. Now, I was just speaking to a colleague this morning. There's a project just less than a mile away that's actually launched at £550 a square foot. This is again one of the virtues of the business model. We underwrote 104 units in that project. And that's why we got some really, really good value here. And then flicking across to Europe, if we go on to the next slide. So I was at the Berlin project recently, Eves Quarter. That is a very, very interesting location. So we've done a lot of work in city centre Berlin. We've now moved out into the suburbs. We've moved to an area called Köpenick. We've worked here before. Why Köpenick? Well, the reason is because it's the epicenter of a lot of economic growth. It's close to the new airport. It's close to the new Tesla factory where there's 18,000 employees. It's close to science parks, and it's only 25 minutes by train into the center of Berlin. But it's 700 euros per square foot as opposed to 1,000 euros per square foot in the center of Berlin. So very much what we look for, a bread and butter growth location with a superb developer and all the benefits of investing in Germany, as I mentioned earlier. And flicking over to Boulevard in Curie Park. So Leipzig, fastest growing city in Germany. Why is that? Well, again, it links back to the Berlin Wall. When the Berlin Wall fall down, this is on the east side of Germany. So everyone went west when the Berlin Wall came down. Population dramatically decreased. Local government decided they had to do something to try to improve the situation. They put in place a 20-year investment plan. That's led to the population going full circle, increasing massively, road infrastructure, rail infrastructure, everything picking up incredibly. And therefore it's feeding into the property market. But property prices are sort of half to 2/3 of Berlin. So having been there again recently and seen it with my own eyes, Leipzig, as part of the whole German story, represents a really strong opportunity to buy property in a major German city from 300,000 euros. And finally, Portugal. Portugal, the golden visa. Again, I said it's an investment first, passport second. On the right, Sosa, which is a WeWork type commercial asset in Lisbon. Lisbon is very much the heartbeat of European office space letting. It has incredibly high undersupply rates. Most buildings are running between 100% and 95%. This is prime Lisbon. You can invest here from 350,000 euros. And on the left, an opportunity in what we call a low density area, which is as close as you can possibly get to Lisbon now, where you can invest from 280,000 euros to buy property, which will again lead you to an EU passport. So if you'd like to discuss more of those opportunities, do come back to me. Okay, that's the end of the presentation. I do try to keep these sort of short and sharp, but we have got time for some questions. I've seen on the feed, we've got a lot of questions that have come through, but I'm just basically going to pick out some of the key questions, and then I will certainly answer them by email to follow up to you. But let's just go through some of the key ones. Someone has asked here, what is the impact of higher interest rates? Very good question. Very topical. As I say, we're likely to see interest rate rises here in the UK this week. I think fundamentally what we're seeing is this. So higher interest rates is clearly meaning less people are buying. What that means is more people are renting in an already undersupplied market, which means that rental inflation continues to be strong. I read a report to say that there's actually between 20 and 40% less property in the market than pre-COVID for a whole host of reasons. And now we're going into the busiest time for rental of the year. So the rental market is going to remain strong and solid, and we're going to see lots of inflation there for quite some time, which is going to counteract a lot of those interest rate rises. But do bear in mind, most of our projects do not complete for well over a year, which is when you do your mortgage. And I think it's fair to say that we are coming towards the end of the trajectory for interest rate rises. And therefore, going into next year, when you come to do your mortgaging for any of these opportunities, I'm pretty sure the interest rate outlook, interest rates will look very different to how they are now. But also as a point, because we underwrite these deals, because we've seen less people buying, we are able to negotiate better deals now. That's the point. We've got a slight window of opportunity where, using our business model, where we put down our own capital, we can get slightly better value at the moment. And I say slightly because it's such an undersupplied market. So there is not a fire sale going on by any stretch of the imagination. Currency opportunity, someone is asking here. Is there any currency opportunity for me as I'm living in Hong Kong? The answer is yes. Have a look at where the pound is now to 6 months ago. You'll be talking about 8.6 Hong Kong dollars to the pound. About October time, now you're looking at just under 10 Hong Kong dollars to the pound. Similar with the Sing dollar, it's tracking sort of 171 to the pound today. Have a look where it was in October, and the same with the US dollar, etc. And also it's the same on the euro side. So what you've seen is the pound and the euro being incredibly weak, but they are starting to filter back up now. So this is another reason why I think it's very important to look at investing in these markets, aside from all the fundamentals I've talked about, as to why it's a good time to invest in property. You have the byproduct, you have the insurance of getting it in at the right time from a currency perspective too. Okay, 3 more questions. Tax advantages of Germany. Okay, I did mention that, but it's well worth recapping. Hold your property for 10 years, no capital gains tax. You can offset your mortgage interest to your rent, so it's tax efficient month on month. You've also got something called depreciation, which I won't get into the technicalities of now, but I have a really good presentation. If you'd like to have that, do let me know. And also don't forget, interest rates, 3.91%, 10-year fixed rate. It's a fantastic rate you can lock in with solid confidence that your rents will be going up over that period of time. How is the UK rental market? Okay, well, I could go on and on about it. As I say, we manage just shy of 6,000 properties in the UK. We have hardly any vacancies at all. Up to 40% less stock, rental stock in the market since before COVID. Rental inflation double-digit right the way across the country. Less people buying because interest rates have been going up. More people are renting as a result in an already undersupplied market. So from an investor perspective, they can invest with so much confidence that they are going to get a tenant, they're going to get a rent, an increasing rent to counteract higher interest rates. Okay, undersupply in Germany, is it similar to UK? Well, the answer is yes. It's very similar to the UK. Again, it all comes down to slow planning rules and regulations. It all comes down to increased regulation around building, the quality of build, energy efficiency. Takes a long time to get planning applications signed off. Interest rates, meaning less is being built because of those costs going up. So undersupply is here for the long term for a multitude of reasons. And then the final question, can you share more on Manchester and Berlin? So, okay, I think the point I've touched on those projects, but certainly if you require any information on any of those projects, then do drop me a line and I can provide the necessary detail. I think just as a closing remark for Berlin and Manchester, so I went to the Eves Quarter project. I went to the Bailey project in Manchester recently. I think the point I would make is this really does extol the virtues of our business model. The fact that we invest our own capital, we do a tremendous amount of research and due diligence on the developer, the location, the rental market, the availability of mortgaging, supply v demand, ultimately what's going to increase the value of your investment. And both are really exceptional opportunities. Bailey, as I say, we took the whole scheme and we got £380 a square foot average pricing compared to, as I say, a recent launch we've just seen today at £550 a square foot. Incredible value in the centre of Manchester. And the Eves Quarter project in Berlin, a very middle-class suburb, Köpenick, close to the Tesla factory. Tesla have been you know, just crying out for property for their employees. These are 18,000 highly paid, highly skilled individuals who are having to commute in for quite a way away to the Tesla factory. Something like Eves Quarter will rent very well to the likes of Tesla workers, and also ultimately secondary market. That's potentially your buyer market. Those type of guys earning really high salaries at Tesla, and the science parks, and the airport, Rolls-Royce, Siemens that are based there, and people working in the centre of Berlin in a very, very attractive suburb. So, okay, there's just a few reasons for those two projects. All right, so I think we'll end it there. I try to keep these presentations under an hour. Hopefully that's been very thought-provoking for you. As I say, I didn't want to just talk about projects. I wanted to talk about why property now? And hopefully what I've shared today has really give you some very, very good information and confidence as to why investing in property right now absolutely makes sense. So all it remains for me to say is thank you very much indeed for attending today. If there's any other information you require, do drop me a line. It'd be a pleasure to help. It's been great to have so many of you on the webinar today. And may I wish you a good afternoon, a good evening, wherever you are. And I hope to see you all again very soon. And thanks again for joining today. Thank you.